We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Tavi Costa, Portfolio Manager at Crescat Capital. Tavi, thanks for joining me today. How are you?
Thanks for having me, Tom. Looking forward to this, and I'm great. How are you?
I'm excellent. It's always a pleasure to catch up with you. And when I prep for these interviews, always just such a treasure trove of charts and data to go through, as you're known for on Twitter here. And I want to start by kind of taking, let's say, the metals complex as a whole. Should we be looking at all of the other metals in terms of, let's say, a gold ratio, like gold to copper, gold to silver, gold to platinum, maybe, to understand, let's say, the current maturity of this metals bull market?
I think if you're of the belief, of which I am, that once you have enough reasons to have conviction that we entered a gold cycle, and I think there's many ways you can measure that, but it really starts with gold prices making new highs, and some people will say that that's the end of it. And in my view, when you reach that level of price discovery moment, particularly at a time when we have so many imbalances in the macroeconomy, globally speaking, I think we're in the, at the I wouldn't say at the initial phases, is not the very initial phases, but early innings is still of what I believe to be a long-term cycle for mining and for gold. And why am I saying this is because gold right now is or I should say other metals are extremely cheap relative to gold. And why did gold move first? I mean, I think gold is just the easier path for understanding as a thesis overall. It's got low volatility. Central banks own it. Central banks are desperate because of the instability of their fiat currencies and so forth. And so you have a much easier way of explaining the thesis relative to other metals that have much higher volatility, lower liquidity, a different demand spectrum as well, even from a supply standpoint too. And so industrial properties and all sorts of things that you can come up with. But at the end of the day, the investment cycles overall are, when you get to those cycles, regardless what it is, the dollar, the technology space, gold, commodities, when you reach a moment where you enter a long-term trend of something, you get to a situation where there's a level of acceptance of risk, in my opinion. And that acceptance of risk is it translates into different assets that are usually linked to that certain cycle that has been unleashed. So in the example of gold, for instance, once people start making money with gold, it's natural to think about what's next. It's natural to think about what's lagging gold prices and what is the next gold type of movement. And that acceptance of risk then takes you to understand silver, understand copper. Now, copper is having its price discovery moment, and it gets down to the mining space. Why we're seeing the mining industry beginning to outperform gold itself recently, particularly the senior companies, and now we're seeing the juniors starting to outperform the seniors. The same thing is happening across most metals. But overall, the way you can kind of see these things is that most of these metals that are linked to gold prices, they usually end the cycle very overvalued relative to gold. And if that's one check of our long list of checklists that we need to go through as investors to make sure we're not late in the cycle and holding a lot of assets in this industry, that is certainly one of them. And so, in my view, I think we have already crossed level of conviction that we are in a gold cycle. And it's time to be looking for, not to be bearish on gold by no means. I'm not saying that at all, but to really be looking more comprehensively into other metals that are usually strongly linked, and pretty much all of them are strongly linked to gold prices over time, that tend to lead the cycle once the cycle begins. And so, lots of skepticism towards silver. Why hasn't led yet? No problem. Let it take its course naturally. At some point, it will, in my opinion. And so, I'm extremely bullish on all these other metals that are yet to catch fire here as we continue to see gold prices in this, again, price discovery phase that we have entered maybe a year or two ago.
Mm-hmm. I find it really interesting to really look at this example to instruct us to illustrate really how interconnected the commodity space is, right?
Yeah, I mean, at the end of the day, now I given an example the other day to an investor that I thought was fascinating. I mean, there's, why do you see platinum, for instance, platinum prices have a very strong correlation with Brazilian equities, for instance? There's nothing to do with the fact that Brazil is a large exporter of platinum or anything like that, but rather because, just like platinum, Brazil or Brazilian equities have the tendency to be one of those down the bottom when it comes to understanding the cycle of gold. When gold really gets unleashed, you tend to see all these other derivatives of gold to do very well. Brazilian equities is just one of them, but it could be Chilean equities, it could be Mexican assets. There's so many different things that can be unleashed when you get to a gold bull market. And I firmly believe it's really hard to find which ones are the absolute best. I caution people to take that type of approach, because you should really spread your wings around many assets that tend to have that strong correlation with gold itself. Mm-hmm. I like a lot of assets. I like Latin America, including Brazil, Argentina, Chile, Peru, Bolivia. I like all sorts of other metals, including silver, platinum, palladium, zinc, copper, nickel, and so forth. So you always looking to, in a way, diversify. And I think the community a lot of times tends to get really hung up into, no, it's platinum that it's going to be, and nobody really knows what's going to be that outperformer this cycle. There's never one answer to these things throughout history. So I take the approach of just looking at these things as, again, acceptance of risk. I think we're in the process of accepting the risk of copper. It's an easier also a thesis than silver to be understood. Why? Because the industrial properties, and you have all the the likelihood of what we're going to see likely with the demand of electricity consumption in the US and globally, given the fact that we're going to see onshoring and artificial intelligence taking place. On top of it, you have the electrical grids that need to be revamped and all these things. So it's sort of natural to go to the copper space. It's becoming natural to go to the silver thesis as well. Therefore, why you're seeing that reflection on the silver price more recently, which I find it fascinating. As we speak right now, and this could change any second from this interview, we're trading at around $39 and call it 50 cents per ounce on the silver price. Mm-hmm. $40, a pretty important move or level to be broken here. This could happen any moment, and I find it remarkable that it's just quietly doing that, and not a lot of people are really talking about it as much as they should. And so that's the usual sign that you have that we're really at the early stages of a bull market and all these other metals. Gold to silver ratio at 85, still 86 or so. With silver prices of $40 an ounce. Name me another time in history we've seen this. I mean, this is a wonderful setup from a macro standpoint if you're bullish in the space. And so I mentioned this the other day, Tom, as well, to an investor. If you look at the gold miners to gold ratio, of which a lot of skeptics in this industry have usually talk about, how the mining industry has really underperformed gold over the last 30 years. Okay, look at that chart and then put the TSX Venture on the same chart. So miners to gold ratio versus the TSX Venture. Mm-hmm. What you're going to find is that it's exactly the same chart. Maybe I'll send it to you so you can add it to this interview, but you can see it exactly the same chart. And why is that? Is because as investors begin to accept the risk of buying a mining company rather than gold, it's no different than starting to go down and in this industry as capital starts to trickle down into the riskier parts of this industry. And the same thing happens with other metals. And so I find this fascinating, and I also find it fascinating that people are ignoring that we're seeing clear signs that the money is trickling down. And there's so many skeptics. And you look at the weight of the mining industry relative to the global equity market, and that's going to be so much construction in the world over the next 5 to 10 years. In the US alone, my calculations are kind of staggering how we're probably going to see construction take place from AI, onshoring, housing, all sorts of angles that you can go into. So I think it's going to be fascinating how this is going to unfold, and really exciting for mining investors, in my view.
Yeah, I think it's really interesting to take this broad look of this confluence of factors that do seem so positive. I put that platinum to Brazilian stocks chart up as you were explaining that. It's an amazing correlation. And when you look at silver, for example, we have this massive cup and handle formation. We have lease rates surging, and some of the ETFs not even having shares to be able to borrow against them. So, what are all of those factors for silver just pointing towards a bigger breakout, or is this just a fundamental setup that doesn't necessarily have a time associated with it, but this just aids our understanding in figuring out that this is just one of these markets that is insanely undervalued. We get in, be patient, and understand from this fundamental perspective, with all of these confluence of factors lining up, that this is the right place to be.
Yes, and this is what I think people sometimes dismiss, the fact that silver is starting to move. I mean, you look at a chart over the last years, silver has done well, and despite all the critics that usually are related to the fact that silver bulls have been expressing their views about a potential explosive move because it tends to be so explosive historically and it hasn't happened yet. That doesn't mean it won't happen. What I find it important is the leverage the silver investors are able to obtain through buying still mining companies that have a lot of leverage to silver. I don't think the level of skepticism is so large in the space that allowed us, who honestly had no type of history transacting in the private markets and buying large mines, to do a leverage buyout of the fourth largest silver mine in the world. I don't think you would never be able to do that, or I would never be able to do that, if with partners, of course, without a market of this level of skepticism. So, conviction, preparedness. I mean, it's all coming together for those that have been in the space for a long time. For some, it's all about owning the physical metal. For me, it's real looking for ways to create transformational wealth. That's where I'm here for. I'm not here to a world that is about to end or anything along those lines. I'm not a doom and gloom type of person. I'm extremely optimistic about the world. And I think that this is simply a supply and demand issue that has a lot to do with macro imbalances historically that we have reached today. And some aspects are unprecedented. Others have incredible, analogies with prior periods in history. I think this is the beginning of an inflationary era. That doesn't mean inflation can decelerate like we've seen recently, but in the last few months, I think inflation is accelerating again. Look at all metals that tend to lead inflation as well. So, I think this is a real opportunity, and so. And probably the largest one I've seen in my career. And it's why I'm so focused in silver and other metals that are catching up to this space. And I think I'm not calling myself necessarily crazy young. I'm 35. We'll turn 36 on July 29th, so very soon. Hopefully silver will be above 40 so I can celebrate. But my point is, when I've seen this situation in the setting, I was, this is my opportunity to take advantage of what I think it's one of the most important macro setups that I've seen in my career. Not just buying silver, but looking for ways to connect with this industry in a very contrarian way, because it's just, this is probably the most a legacy space. If you think about the importance of mining in society, that has completely lost its way given the capital depletion we've seen over the last few decades and how cheap and undervalued this is historically. And when you match low PE ratios or low multiples with growth, that is the nirvana type of investment opportunity they usually tend to find. And so I find this fascinating how most of these mining companies are going to be likely really generating cash like they've never seen before, just because there's so many things going for these companies over the next few years from a demand standpoint and supply, that is hard to believe they're not going to be major winners in this space. And despite all this, most of the guys in at least my age are just focused on crypto, and I find that great. It's more for me, so so it's not bad.
Well, Tavi, we mentioned platinum and how it reacted recently. How do we kind of correlate that to where the lease rates were last month and how they, let's say, what lease rates did and then what the platinum price did afterwards?
Yeah, so lease rates are usually a good way to sort of measure the insights of the industry. And that certainly happened with platinum prior to this large move we've had, the surge in platinum prices that some people think it's geopolitically related. Some others think it's supply related. Again, I think you can come up with all sorts of unique ways to explain these moves. To me, it comes down to acceptance of risk once again, that we're in that process of going through. And so, silver is going through something similar. And I really think that this consolidation that we're seeing in silver prices right now, around, especially where we were not too long ago between 30 and 35. And now we're seeing the spike in prices, close to 39 or close to 40. I think we're going to chase the prior highs of 50s very soon. Nobody knows when, but it could happen, any moment. And we're not too far from those levels either. We may hit a little bit of resistance, and all, again, most technical guys are going to come out and say, be careful and all that. I'm not here for that type of movement. I'm here for the big movement. I think ultimately we're going to break out from there. I expect silver prices, this is just my opinion, to be at making new highs by mid next year. Sometime until mid next year, I think we're going to be at new highs, and I think we're going to hit exactly what gold did a year and a half ago when we did new highs. We reached new highs. We went through a price discovery moment, and those are the explosive moves you tend to see. I think we're about to see that with silver, and then on top of it, you start looking at the fact that we have this massive cup and handle, perhaps the largest cup and handle of any macro asset that I know of, and those usually tend to resolve itself in also really significant moves. And so a lot of things are going for silver. You can also do the analysis. You said leasing rates, but even in our own mining operations at San Cristobal, we can see that the sale of concentrates are certainly going at a premium right now, and for many reasons, and especially coming from Chinese parties and others. And so it's a real it's interesting how governments and countries are going above and beyond to secure metals. Maybe we can get into this topic, the MP materials topic, because I think that's also very it marked a pivotal moment for this industry as well, when I'm talking about the overall resource industry right now.
Mm-hmm. Yeah. What you're talking about is that the Department of Defense recently took a 15% ownership stake in MP Materials. So is that, a bailout, or is it, a recognition of a more important structural vulnerability here?
It is. I think it's fascinating what happened. I mean, if you look back in history, this 15% stake outside of bailouts that we've seen, it's the first time that we've seen this since the World War II. Of course, of this degree, we're talking a 15% stake on a public company. It creates so many questions, right? Think about, if you're a 15% owner of a company, are you involved now with the decision-making process of this, of management and so forth? And if so, that's the DoD participating on those meetings. And was the DoD involved with this Apple agreement that they just had recently with MP Materials as well? Is this serving as just the beginning for more transactions like that? Immediately when I saw this, I wanted to know, where's this money coming from, first and foremost, and where's it sitting, and whose balance sheet is this sitting on? Is it the Treasury? Is it the Secretary of Defense that is making those decisions, and that sits on the defense of the Department of Defense balance sheet? And you start looking at what's, they do have a balance sheet, and how much cash do they have? Is that unlimited? And I've always been of that view of I remember talking to a few CEOs back maybe 2 years ago and talking about the classic cases in the mining industry of very large copper gold deposits that are underdeveloped for many reasons, usually for economic reasons. Some of those massive deposits that are going to take $15-20 billion to put into production, that for private investors and investors in general don't make a lot of economical sense to put that level of capital for at the current prices of metals. But for governments, what is $15 billion, $20 billion of capital spent on those things? I mean, the private administration would spend that on a day in Russia and Ukraine war. And so, and this is not again bash on that side either. I'm just saying that the government has pretty much unlimited amounts of funds to go after these types of developments. And so I'm very open-minded to that type of engagement moving forward. And believe it or not, this is kind of, does that mean this is a state-owned company? I mean, Petrobras has started that way, right? And others I'm talking about a Brazilian oil company now, but there's other South American countries that also have engaged in that level with resource companies, and that they deem to be critical as well. And look where we are. This is not revolutionary what's happening in the U.S. In fact, is more of a sign that we're closing the gap between what the U.S. economy is as a capitalist agenda versus other places in South America, perhaps, or Africa, or China, or others. And there's so many ramifications of that analytical process that comes from this NP material transaction. For the industry, I think it really shows that we are really in a very challenging scenario right now, and that the lack of materials really poses, in my view, a real risk for this innovation process that we're seeing through AI, and also the defense mechanism that we're trying to revitalize through onshoring and trying to get back into our roots of industrial and manufacturing capabilities in the US that we didn't that we used to have back in the days. And so I think that's it shows not necessarily desperation, but first you panic and then you act, and I think we panicked maybe 6 months ago, and now we're starting to act on that panic phase, and this is, to me, just the beginning. And so if you're an investor, this is absolutely critical, and it's very likely to be. There is a whole investment council in the Department of Defense. For those who didn't know, that makes those decisions, and who is sitting on those boards? It's just so many questions that I have that I think are, believe me, they're not answered. You can't really answer those questions with what's the information out there, and I find this all really interesting.
Well, it is going to be interesting to see how that develops going forward, and if there is more of a recognition and more action post panic, right?
Yeah, I think that it's all sorts of metals are probably going to play a role here as well. Opens up for the uranium industry, for the gold industry, believe it or not. Of course the copper industry too. There are so many different ways that you can think about what are likely to be opportunities again. And again, I think we need to change and at least act more open-minded to the fact that Robert Freeland has been saying this recently, and I completely agree with him. And I completely agree with him. When I heard him saying, I said, yes, that's right. I mean, that's exactly what's going on. He said something in regards to how Western investors have been, with this NPV, net present value of idea of how to value an asset. And when you're comparing to a Chinese party, or you're competing with a Chinese party to acquire a certain company or a project, and there's the way they're coming up with their valuation is not on the back of how much cash flows this company is going to generate, but rather how much can I secure of metals. And it's a very different way of approaching this. And it's exactly what's happening right now with the government engaging in that way in the U.S. is to me a shift of how they also are approaching the overall mining industry. In fact, if you look back in the World War II, the transactions that we saw during that period were really a lot of factories and all sorts of those types of projects that back in that time were being acquired by the government or the U.S. government with the idea to maintain the stability of those of that critical part of the economy during a wartime. Where you had to maintain vehicles, aircrafts, all sorts of things that we were building during the war, and so to go back to something like that, I mean, that we're seeing now, it makes you think about, are we, maybe we're not, some folks would say that we are in a war already. And I wouldn't necessarily disagree with that view, because we're acting like we are, and clearly these are types of the decision making that we're seeing from the Treasury and the government overall certainly resemble periods of war, and so it makes me think that we're probably already acting that way, and this is why I believe so much in this onshoring idea. I mean, there's a really good chart. Sorry to go on this, but there's a really good chart. I think Elon Musk actually posted, and I posted in a prior letter, that shows the electricity consumption of China versus the U.S. and basically shows that we're going to see another equivalent of a U.S. economy of electricity demand being created by artificial intelligence. And a lot of people focus on that conclusion, which is really important. But there's another conclusion you can see in that chart that to me was kind of off the radar there. And that really is the fact that if you look at China being the manufacturing plant of the global economy for so long, you can see a steady growth of electricity consumption, while the U.S. has been a flat line over the last 20 years or 30 years maybe. And if we're going to see onshoring, it's just natural to believe that we're probably going to see that curve start to move upwards. And if that's the case, on top of AI and all these things, where are we going to be? And you start looking at those McKinsey and all sorts of different consulting firms that put out estimates for electricity consumption. I think they're way off. Anyways, there's even more research you can go into on this as well, and it's extremely bullish in my view for metals.
Mm-hmm. Well, I mean, it's a perfect illustration of the idea that we don't have enough metals, we don't have enough power generation capacity, and power generation and just energy in general is directly tied to GDP. And those are really interesting charts to look at as well.
Yeah, and you can, I think you could break down to 3 pillars of investment opportunities when it comes to what's been happening. One is the energy source. Where's the energy going to come from? So assuming the electricity demand is likely to be, surging from here, and I don't mean it in the next 3 years. I mean in the next 20 years, 15 years. I mean in the next 5 years. Mm-hmm. If the electricity consumption is going to surge from here, something we haven't seen in maybe even going back this full century. I went back and I had, I was looking at data like that, and you got to go back centuries to see what we're probably going to see this time. And what is interesting, you can break down to 3 pillars. One is energy source. And now I'm going to upset a community of the mining industry right now, which is the uranium industry or the nuclear space, mm-hmm. that tend to say, well, that's the answer. No, it's not the answer for the next 5 years. It's not your answer. We're talking 5 years. We're not talking 15 or 10. Mm-hmm. We don't have time to build a nuclear plant and have it operating in the next 3 to 5 years. We do not have that time. And so the answer short term is really 2 things. And it's one a lot more than the other. You can say solar. Yeah, solar maybe in the near term. 5 years is a very short term. Are we going to be doing those things in China? I mean, majority of the solar panels are built in China anyway, so we're going to be buying more. I can't believe we're going to necessarily do that more and more, but I'm not bearish in the solar industry. I just don't think that that's, again, that's your answer, immediate answer either. It's natural gas at the end of the day. Natural gas is going to play a major role into this. And we do have enough natural gas, especially if we create some sort of partnership with trade agreement, I should say, with Canada and so forth, of which I think it's inevitable as well. A lot of people are bearish on that. I think that's inevitable. And as we see those things playing out, the coal industry could be revitalized as well. I mean, coal industry has a lot of aging infrastructure and have issues in terms of scaling up with the current infrastructure. We may see that come back. Investments on that front. If you read the bill, the big, beautiful bill, there's all sorts of angles on trying to push the coal industry to see a comeback. And so But the big one is going to be natural gas. And when you dive into natural gas, it takes you to the second pillar, which is infrastructure. And the second pillar is fascinating because it breaks down a lot of different things. Investments on the side of infrastructure could be pipelines, for instance. Do we have enough pipelines to call it, current energy, energy source? Natural gas is about 40% that we're using today. Can we take it up to 60? Mm-hmm. And if we are, what do we need? Pipelines is one of the things. We're going to have to build parallel pipelines, and we have the time to do it, but we're going to need to do it. What do we need? Steel. We're going to need a lot of steel and iron ore and all sorts of things, not just for pipelines, but for other infrastructure developments. Think about the grid, which is the obvious question that lots of folks usually tend to focus on. And rightly so. The grid requires a lot of changes as well, and we're going to see all sorts of developments in that part of the economy. And now it takes you to the third pillar, which I think this NP Materials is just the recognition moment of that third pillar, but potentially there's a lot more to come, as I said, and that's the material side of it. We don't have enough materials. We don't have enough metals. We don't have enough raw materials to make those changes. And while there has been a lot of focus on the energy source pillar and the infrastructure pillar, the raw material pillar, it needs a lot more attention. And maybe we have reached that moment of that pivotal moment of recognition that has been triggered. And I think that there's a lot more to go. And this is where mining starts to become more and more a vital part of the U.S. and global economy. This is where capital starts coming back to this industry, maybe not even from a value standpoint, but rather from a desperation of need that we have as a society to bring more materials, raw materials back into. It's like Elon Musk said the other day. We have enough copper. That's not the issue. Yes, we do have enough copper, but most of it is underground. It's not above ground, and we don't have enough deposits that will be coming online to produce enough metals for the next 5 years. That, as I said, and 7 years that we're going to be needed. If I'm right about this demand for electricity, literally surging from current levels, and so that's a real concern. I mean, a black swan event that involves electricity shortage is a real risk for the U.S. economy specifically and the global economy, and you have to see this from the lenses of where capital needs to go even before we have the right infrastructure to now let AI take its course. And so otherwise we're going to hit a wall here soon.
Well, I mean, the age-old saying of the cure for low prices is low prices, I think has never been more pertinent to understand and to consider, right? When we have low prices and we've forgotten to invest in much of this infrastructure, going back to the oil example, when we have rig counts falling because of lack of investment, we have inventories falling because of, lack of production. This applies seemingly across most of the commodities complex, right?
Yeah, absolutely. And it's why I think, for instance, a lot of these things that are happening right now, in the investment world, usually, at least that's the way I approach things. I try to identify these big macro trends. And as we see volatility that we cannot, really predict a lot of times, these types of crazy volatilities that happen in markets, you take advantage of the volatility, especially the downside volatility that is provided to you, especially if you have a long-term view. And there has been a lot of skepticism recently, especially regarding Brazil, because of situation between Trump and Lula and so forth. I just don't think these things are going to stick, and the reason for it is because both countries need each other. At some point, it's like when you have a new politician in the middle of a metals cycle, you have a new politician come in place in a South American economy, and they're usually bashing the mining industry and so forth. And as soon as they realize how much capital is pouring into the country coming from that industry, they back down completely from those policies. And that's the usual trend, particularly when you are in a cycle. And so I believe strongly that all these things are noise. They're major noise, and really are not as important as the point of finding where is the source of those raw materials or the infrastructure or the energy, as I said before. And a lot of those things are going to be found in South America, in my view, given the proximity, given the easier relations you can see with different countries that are likely to get better. And these are also going to be major investment opportunities as well, in my opinion.
Well, Tavi, many of these resource companies are listed on the TSX Venture Exchange in Canada. And looking at the chart of the whole exchange, it's also kind of confirming interest and volume coming back into the sector. Is that right?
Capital is definitely trickling down now. I find it interesting that companies with the name silver in their name, in the company name, are starting to see more volume as well. Again, it's all an acceptance of risk exercise that every investor is doing right now. Things that have very low volatility, very high volatility and very low liquidity are starting to become more attractive. Why? Because they have truly lagged gold prices in a substantial way. They're still trading like gold prices are at $1,000 an ounce, believe it or not, in all sorts of deposits, and companies that have likely found major discoveries are starting to see flows. This is a really good thing. I've always been of the belief that especially the exploration part of the industry would be one of the biggest winners of this cycle. And I didn't want to get too cute on trying to figure out exactly how this whole thing would play out by year. But I think we're getting extremely close to those very big moves that we tend to see in this industry, where most of the major companies started the mergers and acquisitions process have begun, but really the first ones really were across most of the majors, and majors trying to acquire also some mid-tier companies. And now we're starting to see the real engagement. Actually, engagement started maybe a year or two ago. The real level of investment now is starting to take place. And I think that's...
Sorry, Tavi, just to interrupt. I have your chart of the TSXV up, and it certainly looks like it's trying to break out of that long-term trend line.
I think this is probably one of the most important charts if you're a resource investor. It's something all sorts of investors have been waiting for that moment. I've heard so many times from different types of people that this industry is broken and will never come back. Those are usually cool words of things that are at the bottom and ready to start moving again. This industry is not broken. It's just, we have a lot of problems. There's real bad management in lots of these companies. There's too many companies. There's all sorts of issues. I'm not saying there are no issues. There are brokers. They're recycling capital from flow-through funds, and also there's so many issues in this industry, in my view. However, there's a real need for metals. There's a real need for discoveries as well. The majors have been depleting their resources for a long time. They are in need for growth. Investors are going to start moving from I want dividends, I want buybacks, to I want growth very quickly. You see it. And as we see that, it's only natural that they start looking down to companies that have done their work, that have done their homework, and found major discoveries, or at least have enough evidence that they have major discoveries. And so, it would not surprise me at all to see some Maybe the ones that are, again, acceptance of risk, maybe the ones that are more obvious are going to be the first one to be taken out. Mm-hmm. And as we see that trickling down more and more down this overall industry. But what a time to be an investor here, because very few know what they're doing. It's truly a niche part of the economy, because we have a lack of geologists, we have a lack of fund managers that know that have developed processes to invest in this industry, and it's going to be, I think it's going to be, the Wild West when it comes to alpha generation, in my opinion.
Mm-hmm. So Tavi, what could go wrong from here? There's so many of these factors that we look at that are so bullish for this industry. Obviously, it's going to take time to play out. Obviously, we don't know exactly when it's going to, really light that candle. But what could go wrong from here that could kind of derail this thesis yet?
Well, a lot of things could go wrong, right? I mean, I think one of them is, have we reached? I mean, at the end of the day, governments have two ways, two paths, and I think that investors in the metal space ultimately believe in the one of the paths in a big way, because otherwise, would be well, what am I referring to? One path would be, we reach too much debt, we can't spend anymore. Tavi, what are you talking about? Like, you're saying we're going to see a major construction boom. Boy, we have leverage all the way to above our necks, and there's no way we can handle this. Mm-hmm. And so, what if we're just going to see a default moment and so forth, and all these companies and governments are just not likely to sustain the level of capital commitment to see all these things come to fruition? Well, that's one path. And if that's the case, that's kind of your 2008 deflationary shock and all sorts of issues. I don't think we're going to go there, because that's the painful path. Both are painful, but this is the real painful path. Mm-hmm. That's your Great Depression type of path. The second path, on the other hand, is the one that, is the one that we just saw, the big, beautiful bill. And that's inevitable in my view, just because that's the easiest path. It's inflate your way out of it. And some governments, I'm referring to a sentence coming from Scott Bessent, the Treasury Secretary, who said recently, not recently, but he has been saying often that we're going to grow our way out of the debt. Well, that's a cool word to say. We're going to inflate our way out of the debt, not grow. Mm-hmm. And so, if we're going to inflate our way out of the debt, we're going to see all sorts of liquidity injections that are going to come to place. We're going to see, what we're experiencing right now with the Fed chair, Jay Powell being challenged, and potentially a Fed chair taking place, and forcing rates lower. That's fiscal dominance. That's lowering rates. I mean, think about this. I mean, if we take rates to zero right now, we're still paying 4% of deficits right now. So, it's very unlikely that we're going to stop the fiscal spending anytime soon here. And as we see that occurring, the first step is going to be probably fiscal dominance. Fiscal dominance is just, the fact that we're going to be driving rates lower to reduce our interest payment on the debt, and allowing fiscal pro-growth spending to take its course. And, that's the first step. But as we see entitlement growth and all these things, it's going to start questioning how much of that fiscal spending is really pro-growth versus non-growth. Mm-hmm. And that's where I think other governments, or I should say other countries, are going to start seeing this end of the U.S. exceptionalism, because at some point we're going to see that pro-growth is going to be more and more challenged, and the capital is going to start flowing out of the U.S. into other places as well, especially as we see these types of policies like the MP materials that start reducing the gap of capitalism that we have. The purest form of capitalism that we have is in the U.S., probably, as a large economy, versus all these other more more I guess socialist types of economies like South America, for instance. And so all these things are really interesting, and that's what could go wrong. I guess it's that path of defaults, and I don't think we're going to go there. Sorry to long answer, but that would be the wrong path to go if for investors in this industry.
Well, I think it's interesting to consider the second possibility that you mentioned about inflating our way out of it. I think that only ends up delaying this market rather than actually canceling it altogether, because that just sets us up for more. It sets us up in a different way at a further period down the road, rather than right here, right now, and just more counterbalancing of that inflation by gold specifically, and then everything down the line as it's trickling down, right?
And I think as investors, as we plan things long term, I've always said this, and I'll mention this again. I'm not a gold bug. I believe in gold for macro reasons. In the next, call it 10, 15 years, I see a clear trend that gold should be a lot higher in prices. I'm gonna have to revisit that as we go, but I really feel strongly that will take place, and therefore why I've made my decision personally, and even through Crescat as well, to take to invest in less liquid things, because I thought eventually capital would trickle down and would come into this part of the industry. And so that's why I thought that would be the case. But I do want to caution people on one thing that I think it's absolutely critical. This AI revolution is real. It's probably one of the most important things we've seen in history. And it's going to create two things, in my opinion. First is the buildup phase. And that's where we are. That's where we're starting to see. Go and look it up. What's happening with the Stargate construction, and some people are going to be skeptics about the funds of this and all that. Don't worry, the government will come up with a creative way to get the capital. Even if it's not private markets, they'll print their way into those types of major investments in data centers and all sorts of things. And that's just the beginning. There's going to be grid infrastructure and all sorts of things I said before as well. So, you start thinking about this build-up phase. That's where the inflation will likely be developing as well. Material needs is going to drive the demand for metals. The metals are going to go higher. Most likely, metal prices going higher drive commodities. Commodity prices usually drive inflation. So, we're going to inflate our way out of this. Now, what is important is that after the build-up phase, and I don't know how long it's going to take. Maybe it's 5 years, maybe it's 10 years, maybe it's 15 years. After that, it's going to be a huge amount of efficiency and productivity being driven by AI. And that's going to be a very deflationary world, in my opinion. And so I'm very open-minded to that, both of those extreme worlds where you have an inflationary era, then followed by a deflationary era, kind of like we saw in the 70s and then 80s. And so, be very open-minded to this, because I do think we're going to hit something like that at some point in this cycle. Capital is going to probably start flowing out of tech into a lot of these raw materials, because people are going to start understanding the economics of these businesses are going to get better and better with metal prices rising. So naturally, I think capital is going to flow into this industry, mining industry, resource industries. That's what I'm referring to. Infrastructure companies, construction companies, cement businesses. I mean, you name it. All these things are probably going to, see an influx of capital. But then after that, it's going to be a whole different world. And so I'm very open-minded to seeing very divergent macro forces at some point when the build-up phase is done. So yeah, pay attention to that. That would be my 2 cents on where things could go wrong and where the cycle could be either elongated or shortened up by that build-up phase alone.
Mhm. Tavi, one of the last things I want to go over here with you is this basically the structural market that the US dollar is in. When we look at where the dollar has been for the last couple of weeks, where the dollar is headed, in your opinion, does that add another tailwind to this commodities complex, considering that is the denominator through which we measure everything else?
Yeah, I think there's two things in this dollar trend. There's the fact that we're probably going to see fiat currencies devalue versus hard assets, and I think that has been taking place, and will continue to take place. And there's a dollar trend itself, which is the dollar versus other fiat currencies. For a long time, we've seen the dollar receiving a lot of inflows for many reasons, because of technology developments in the US, because of the treasury market itself attracting a lot of capital, and other countries basically financing most of the fiscal stimulus we've seen in the US by buying treasuries. All that has turned right recently, and so we saw first, especially after the invasion of the Russian Ukraine and the whole freezing of their Russian assets and so forth. All that created some, but it wasn't just that. It's been a sequence of facts that have been happening. I think inflation began to. It was the first moment inflation started to get out of control. We haven't seen inflation in decades in regards to even government data, right? That is, really understating, in my view, what the real inflation problem is. But nonetheless, inflation has really started to become more pronounced, let's say it that way. Not that inflation has gone away, by no means I'm saying that, but that inflation became more pronounced after the COVID recession and the stimulus that we saw out of that. And the next phase out of that was that the treasury market has started to lose its control. I mean, we saw, we had to see more involvement of the government in the treasury market. Yields begin to move higher in different parts of the curve, and now we're in a position where the next phase or the next chapter of this has been really the dollar, because the dollar is what is pricing all the securities and these asset classes that are U.S. based, and I think we're just at the beginning of that trend. I really do. Despite the fact that we just saw the worst movement on the DXY index, or the dollar index that most people watch in since the 1970s. This has been a real, to me, just the beginning of maybe a 5 to 7 year move on the dollar. I really, back in, I think was in November of 2024, last year, I wrote a paper about this, and that was to me, it was a real transition of views as a firm, and also my personal views in particular in regards to the dollar, of which I said, I do think the Canadian dollar may outperform the US dollar in the next, 6 to 7 months. And that has certainly been taking place. We've seen a lot of other fiat currencies is starting to appreciate versus the US dollar. And there's a few technical reasons for that. And I think most of the people that listen to this usually say, well, I'm not going to invest in Canadian dollar or anything like that. For the macro guys, they get it. They understand that there's a positioning that can take place into buying these types of currencies pairs that can be extremely profitable. But that doesn't change the fact that hard assets can continue to outperform fiat currencies either. What I'm trying to say is, throughout history, when there's really two imbalances that the U.S. currently has to kind of bring this down to the core of the thesis of why the dollar is likely to devalue versus other fiat currencies. It really comes down to two deficits that the U.S. is facing. One is the fiscal that everybody talks about. How do you fix the fiscal? Well, you reduce rates, and I don't know how you do it, if it's through putting a new Fed chair or doing QE or there's so many different ways you can do it that, I'm sure the government will find its way in order to create that fiscal dominance and reducing rates to reduce the interest payment on the debt. That's one. But there's the other side of it. And I think I've been in your show here talking about this before, but this other one is not new, but something I didn't comment on before, which is the trade deficit. The trade deficit today is probably the last time we've seen this was maybe in the early 1900s, late 1800s, and so forth. It's been it's a real issue in imbalance that we're facing that often doesn't get a lot of attention, despite Trump doing as much as he has been doing, trying to get new trade agreements. And if you look back in history, one of the ways that governments were able to do those improvements was actually by a devaluation of the US dollar versus other fiat currencies. And so, I did the calculation myself. I looked over all sorts of fiat currencies, including the Mexican peso, the Canadian dollar, the Japanese yen, the Chinese currency, the Chinese yuan, and so forth. And you start seeing that this is one factor, but just on that factor alone of adjusting in the currency markets to reduce your trade deficit, you could see appreciations of the Canadian dollar versus the US dollar, or the Mexican peso north of 30 to 50%. So I know these are very extreme numbers, and maybe we're not going to get there. But I think if you put in a chart a 15% improvement on a Canadian dollar, you start seeing some major breakouts. And once the dollar trend gets, started, it's usually a very long-term trend that then unleashes other things, emerging markets and other developed markets and so forth. And so I think we're in the cusp of seeing those things now. We've seen some confirmation of that year to date. And I think that's just the beginning. I think we're going to see a lot more of that take place here in the next call it 3 to 5 years, and that's going to dictate a lot of the flows out of U.S. markets into other parts of the world.
Is that only due to the, let's say, the currency devaluation, or is it also associated with, let's say, the lack of growth or the lack of appetite for U.S. based equities?
Well, there's a lot of things into that, right? I mean, number one is valuation, right? You look at valuation of U.S. equities versus other parts of the world, things are really stretched. That would be one thing. Okay, number two, people used to say the U.S. has one thing, which is the laws and in the U.S. are much better than other economies, and so we should see that premium, but that premium relative to other countries have never been so pronounced. And so I think that's also extremely stretched and unlikely to be sustainable. The other thing I would mention would be the interest payment to GDP that the US is paying of about 4 to 5%. There is no other major economy paying anywhere close to that, nowhere close to that. And so on that alone, we're going to have to see a reduction of rates that is going to be greater in the US than other economies, given its urgency to see a reduction of the interest burden on the debt. That's one thing. And so, those alone are going to be huge parts of this. And then on top of it all, what you're seeing is a trend of deglobalization take place, of which onshoring is not just a U.S. phenomenon. It's a Japan phenomenon. It's a Canada phenomenon. It's an Australia phenomenon, and it's a Brazilian phenomenon. And so, as we see that it's a European overall phenomenon, very likely all these economies are going to do lots of investments within their own countries and try to reduce their dependency in China and others. As we see that occurring, those investments are going to be less international and more based in those economies. the US is going to suffer on that alone as well. So, and on top of it all, I mean, I've never seen a moment where the US can really carry the torch of having about 70% weight of the overall MSCI World Index for a sustainable period. I mean, that just doesn't happen. Flows at some point start finding other better opportunities. Acceptance of risk. People made money in the US and they're looking for other things. What's the next US, or what's the next incredible 10-year, 15-year trend that has not taken place yet, that will probably be the case in the next decade or so? And I think there's a lot of candidates, and emerging markets, in my view, are one of the main ones as well.
Well, Tavi, I know, these are all things that take time to play out, and it's going to be really interesting to see, all of the pieces of the puzzle that we went over today and see how they really progress. Tavi, is there anything that you'd like to leave our listeners to think about before we wrap up here? Or maybe to pay attention to?
No, I think we cover a lot of topics. I think as you think about these considerations as macro ideas, one, the path that I said that we're likely to take, which is inflate our way out of this, the dollar taking place in terms of this long-term decline of the US dollar versus other fiat currencies. And what I find fascinating is that macro never happens all at once. It's always, especially these big trends, they're kind of like a domino effect. And again, I don't want to repeat it one more time, but it's acceptance of risk, and those dominoes begin to fall. We've seen gold be the first, and now we're starting to see copper, and now silver is on the brink. Then now you're seeing platinum starting to move. Emerging markets are starting to move. Look at Argentina. Brazil is waiting a bit, is trying to see what's going to happen with elections. All these things are moving along the way. And so we're seeing Japanese equities moving, and then people lose faith on oil. And it in my view, that's just a consolidation period. Pay attention to the rotation and the domino effect that it's happening across these ideas. And I don't think they are a coincidence at all. And as if it's much easier to see the world that way. And if you are, if you start understanding the world in that sense, you start seeing investment opportunities in that sense as well, as what are the next ones to be moving in that direction. And I think there's all sorts of things. And if we put a gun in my head of which ones I think are going to be the most attractive ones, I really think it's going to be the development and exploration phase of the mining industry alongside with emerging markets. I think those two things are one of the most asymmetric opportunities I've seen in my career.
Well, Tavia, as always, I really appreciate you walking us through all these things, and appreciate all of the charts that you put up and put out, and look forward to the next time to speak with you.
As always, thanks for having me, Tom. And so appreciate as well the interview, and look forward to other conversations as well. Thank you very much.
Excellent. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.